In modern finance, the foundational principle of portfolio construction is Markowitz mean variance optimization, or MVO. MVO is a mathematical framework used to assemble a portfolio of assets. Its core objective is straightforward. The algorithm calculates the exact asset allocations required to maximize expected return for any given level of market risk. But despite winning a Nobel Prize, the raw Markowitz model contains a fatal practical flaw: extreme input sensitivity. To see how this breaks down, consider a standard quantitative scenario involving a portfolio of 10-year international government bonds. These are highly correlated assets, meaning their prices tend to move up and down together. Introduce a microscopic expected return adjustment into the model, an increase of just 5 basis points to the Canadian bond. A basis point is simply 1/100%. This bar chart simulates the optimizer reacting to that tiny return increase. Because the assets are highly correlated, the algorithm instantly dumps all other global bonds to fund a massive 40% long position in New Zealand bonds. These massive, concentrated long and short positions render the raw MVO model useless for actual fund managers trying to allocate capital safely. MVO is a paradox. It is theoretically precise on paper, but mathematically uninvestable in the real world without a stabilizing anchor. In the early 1990s, Black-Litterman was managing quantitative risk at Goldman Sachs, tasked with solving this exact problem. He was analyzing the global bond market, an environment characterized by highly correlated assets acting as close substitutes for one another. When the firm's economists generated their standard expected return forecasts, the optimization models reacted erratically, outputting extreme and dangerous allocations. The typical industry fix at the time was applying arbitrary maximum and minimum weight constraints to force the model to behave. The mathematical consequence of these constraints is that the optimizer simply pushes the allocations against the artificial boundaries. This prevents the algorithm from providing any useful insight. The system did not need tighter artificial boundaries. It required a complete mathematical redesign to accurately handle uncertainty. Here is the reverse optimization equation. Pi equals the risk aversion coefficient delta, multiplied by the fixed covariance matrix sigma, which is a grid showing how different assets move together, multiplied by the market capitalization weights, W. By inputting the known market capitalization weights for W, the engine works backwards to solve for the implied expected returns. This establishes the core philosophical bedrock of the model. In the absence of subjective investor views, the mathematically optimal baseline is simply the market portfolio. With a neutral baseline established, the model must transition to incorporating active investor opinions. It does this through Bayesian updating. This is a statistical method of blending the neutral equilibrium prior with subjective new information to form a mixed posterior estimate, a revised probability calculated after new evidence is introduced. This equation is the master Black-Litterman formula that executes the Bayesian blend. It balances the equilibrium prior, pi, against the investor's subjective views. Inside this formula is Q, the view factor. This is a column containing the absolute or relative return targets the investor expects to hit. To apply views, the model uses Thomas Idzorik's matrix P, mapping 3 distinct views across 30 Dow Jones tickers. In view 2, predicting Johnson & Johnson outperforms Procter & Gamble, the matrix assigns a +1 integer to J&J and a -1 to P&G. These integers create a relative, dollar-neutral mini-portfolio within the algorithm. The long and short positions directly offset each other. Matrix P elegantly solves a massive operational roadblock by mathematically translating qualitative human opinions directly into executable machine code. The algorithm can also handle complex, multi-asset relative views. For example, predicting that General Electric and Home Depot will outperform General Motors, Walmart, and Exxon. Using a simple equal weighting scheme for these 5 assets ignores their actual size. This causes undesired tracking error, which is the divergence between the behavior of the portfolio and its benchmark. Instead, the model uses the He and Litterman method, where nominally outperforming and underperforming assets are weighted strictly proportionally to their market capitalizations. Once the assets are weighted, the algorithm needs a mechanism of conviction. It must know exactly how much to trust a specific view. The model assumes there is an independent, normally distributed error term, called epsilon, associated with every expressed view. This diagram outlines the omega matrix, which is a diagonal covariance matrix of those error terms. It visualizes the inverse relationship between the stated level of confidence and the variance error term, omega. A higher expressed level of confidence mathematically shrinks the error variance. This signals the algorithm to trust the view more heavily. Finally, the model applies a scalar, tau. This parameter tunes the macroeconomic weight given to the implied equilibrium relative to the weight given to the investor's views entirely. By applying a calibration factor, the math ensures that a baseline 50% confidence level provides a balanced, intuitive deviation from the original market weights. The omega matrix and the scalar tau act as systemic brakes. They structurally protect the portfolio from dangerous overconfidence. When the master formula fully executes, it yields the new combined return vector, the posterior distribution. In the Dow Jones example, active investor views were only placed on 8 out of the 30 available stocks. This visualization compares recommended portfolio weights against original market capitalization. The 8 viewed assets behaved exactly as expected, showing significant deviations. But look at the 22 unviewed assets. Their weights also fractionally shifted away from their equilibrium starting points. This ripple effect occurs because individual returns are linked via the historical covariance matrix. The matrix intelligently distributes the estimation errors and correlations across the entire portfolio ecosystem, adjusting every holding based on its relationship to the viewed assets. The Black-Litterman model finally accomplishes the core goal of mean variance optimization. It succeeds by spreading estimation errors gracefully across the entire portfolio instead of maximizing them through a single, violent shift. The micromechanics of stock portfolios provide the blueprint for applying quantitative risk management to macroeconomic challenges and the global climate transition. After leaving Goldman Sachs, Bob Litterman applied these exact portfolio optimization principles to the transition to a net zero economy. Consider a stranded asset. This is a fossil fuel holding, like an oil rig or coal mine, that will permanently lose value as the global economy transitions away from carbon extraction. To hedge this specific climate exposure, Litterman developed a stranded asset total return swap for Kepos Capital. This swap functions just like the Johnson & Johnson versus Procter & Gamble matrix view. It executes a massive relative value short against the market baseline. By shorting a mini portfolio of fossil fuel assets against the broader market, investors mathematically isolate the specific systemic risk. The philosophical core of quantitative risk is pricing correlated uncertainties accurately over a specific timeline. Litterman views time as a scarce resource. In risk management, running out of time converts a solvable problem into a catastrophe. Climate risk compounds over decades because both the concentration of greenhouse gases and the damage caused by each new ton are increasing at the same time. This creates a quadratic risk profile, where the cost of inaction accelerates much faster than the simple passage of years. Whether balancing a yield curve of government bonds or pricing the survival of the global economy, failing to price risk creates systemic collapse. Risk management fails when you lack a baseline. The Black-Litterman model solves the optimization paradox because it mathematically respects the market's baseline before daring to deviate from it.